Yeah, I don't know about what, but we are going to have a discussion about trading today. So hold on tight in here. I am going to set up my monitors first, and then I'm gonna go live. So um, let's give it a 5 minutes, something like that, maybe less. And then I'm gonna start talking about charts and strategies and all of that nice stuff. So let me get prepared and enjoy the music in the meantime, and I will get back when I'm ready. Okay, so let's get started. Let me put this thing in mute. Okay, there you go. Okay, first things first, take this one out. First things first, you know that there is a 90% discount in Apex in Apex, and I wanted to talk about that a little bit, but not from the point of view of promoting it, but the point of view of the risk that you need to face and take if if you decide to go with these guys. So first of all, there's trailing laws that you have to be aware of in the daily in during the day. So if you have to read the rules and make sure that you're following the rules. So one thing that I wanted to talk though is the is the risk per trade that we're going to take. Okay, so I would recommend not to go over 5% of this amount. This is the trailing threshold that you have, and then this one is going to increase every day and in the intraday as well. So I would take a risk not larger than 5% of this amount. So for the 50K, it's going to be $125, which is the 5% of this 2,500. Okay, so don't if it was a real account, I wouldn't take more than 2.5-3%. But since this is fake money or simulated money, and you're risking only 90% of this value 167, it's very, very low. So you can take 2 or 3 accounts on this one, and for each one of them, don't risk per trade more than 125. How do you do that? Just simply by taking, and I'm going to explain it in the chart, but simply by taking one contract with $125 risk at the most. Okay. If you go with 150K full, so that is going to be $250 per account per trade. Okay, so 5% of this one again. That would be my recommendation. Don't go above that one. Okay, so because the most people who don't pass the trade the testing accounts is people that take too much risk in this trade. So the odds, if you're not following the rules, and then the odds could be against you if you're new on this day trading stuff. So be careful on that. That would be my recommendation. So let's go to the charts now. Let me take this one out of here. And let me go back to the chart. So I'm going to show ES, for example, and then I'm going to open this chart. What I'm going to do today is to isolate the, let me see here. I'm going to go to indicators, and I'm going to take all of this visible, the cross builder, I'm going to take it off. The Ichimoku, I'm going to take it off. The wrinkle prices, I'm going to leave on. Open range indicator. This one here, yeah, I'm going to take it off as well. The MQ momentum, I'm going to leave it on. Swing race, I have it off. This one is it's one that it's really not, that it's bothering a little bit. It's good, but one second, I'm going to mute my cell phone. Okay. So I'm gonna take off that. No, the pivots I'm gonna leave it on. They're in the side. They don't bother that much. Ninja price. This one is the higher highs, higher lows. I'm gonna take it out as well. Trend lines. This one marks the last trend. I'm gonna leave it off as well. SMA. This is the 50. I'm gonna take it out. And then I'm going to start explaining what are, for me, are the most important ones. So visible, take this one out. Oh no, this one I'm going to leave it on. I like the colors on the candles. Simple moving average, the 50. I'm going to take this one out. This one is the smooth 50. Color regions, yeah, I don't necessarily bother or track that. Squeeze momentum, this one is below here. So you can have it or not. It really doesn't matter. And then this one here, I'm gonna leave it there too. In the toolbar, I'm gonna leave it there. Okay. So I'm gonna apply this one, and all the indicators should disappear. Okay. So except for this open range, I think that I should take. Okay, I'm gonna leave it there. All right, so here we have the chart. So this is ES, and I'm going to put it from the beginning of the day in the open hours. So 9:30 around this time here, okay? So there's a couple of strategies that I wanted to talk today. The first one is break out of the breakouts out of compression, and then the wicks out of the moving averages. Okay, so really we don't have that much direction in a chart like this, so that's why I like to put moving averages there. Okay, so I'm gonna start populating this again. I'm gonna take this one to another monitor though, so in that way it doesn't bother us. So okay, so what I'm gonna do here is to go with the I do have it in the cross builder, but actually what really I'm interested is in the gold line on this cross builder. So hold on, it didn't open. I closed it. I'm gonna take that one, and then here I'm gonna make it visible. I'll apply it, and okay, that would be probably the first indicator I would plot off, and probably is the most important one. So what is the strategy in here? So we do have open line. I'm gonna right there. So this is 9:30. This one is when the market opened, and that's why I do have this is 9:30 right there. Okay, so this is why I do have the open range indicator here, because it tells, or not the open range, the color, the multicolor zones that I have in my charts. So basically, from here we can start looking at the trend using the moving averages here. So this one is the 34, and this one is the 18. These are the ones that I use. So one strategy that, or setup that I see, is the week out of the moving averages. Okay, so these are the two moving averages that are probably the most important ones. And I look at the entries, and I take 2 or 3 waves. One or two waves. The third one I really hesitate to take. Okay, so if we are in an uptrend, like in this case, you know, the moving averages are below the price, and then the market open and make a wiggle here. Let me extend it here a little bit. Probably I had the feedback from one of you on the weekend that, or on Friday, that my charts were too much populated. Somebody call it like spaghetti thing. So I wanted to go into the indicators I use for that reason. So let me see if I make it clear. Okay, so you do have the 34 EMA right here. Okay, so in this one, if you see up here, we do have a 2 unit Renko. The 2 unit Renko, if you put the stop loss before below this week, right? Then it, or right up around this week or below this week, you are at $120, $150. So I wouldn't recommend to go more than that. Okay. So that is one contract for, let's say that if you're using a $50,000 account, which has $2,500 threshold, that would be $125. Okay, so your stop, your entry, if you see there's a week out of this before the market opened, there's a week out of the moving average right here, but the market has not opened yet. And then we are kind of like too close, 929, we're too close of the open. So right before it, no entries. And then you have 1 week and 2 weeks out of there. If you see that the low here, right, is below that low there, if you enter it here, then you're going to suffer a little bit, but then you are going to be in the trade from this point on. Okay, that is if you take the trade within the 15 minutes. Lots of people don't take trades within within the first 15 minutes. So what I'm gonna do is to Control C and V here and move this one to, and I do have an indicator for this one. Okay, so this is 945. Okay, so within this zone here, right? Some people really don't take trades, okay, in this area here. But there are a couple of trades that you could have taken if you're following just the weeks out of the moving average. The momentum is really within this close. I'm gonna say it that way, close to the zero line, which is this line right below here. So close to the zero line. And then you have momentum close to the zero line, and then moving up. So here you have one entry, and here you have the second entry right there. But it's within the 15-minute opening range. Okay. Now in here it broke above the 15-minute range. Now you have two options here. You could take a trade out of that zone in a breakout of the 15 minutes, and then see what's going on. If you take it here, your stop is going to be around one tick below or $100 down when first crossed up. So let's say that this one is the 15-minute break, or the 15-minute price high, and then when you go and take it, then you're looking for a trade in that breakout to the upside. So that could be an alternative. And then market comes back down and then makes a week out of the 34. Is not really 100% clear or clean because it really didn't touch it. Okay, but it's it went close to it. Okay, momentum is a little bit extended, and then you get an entry right there for, let's say, target, if you take this one, target would be 2 to 1. So you would be trying to reach $200, which is about 220, 250. This one is 125, 150 actually. So you're looking for around that area there where you could move your stop from here to there, right? So you have $150 there, 6 bars. That would be the first target right there. Okay, or the target. I mean, remember that you guys are looking for you're in this case you would be trading one contract. If you're trading the E-minis, okay? So is that correct? 125, 150. Yeah, I would say so. You can even get a little bit more for that target, okay? Or you can have a 4 to 1 ratio and put a little bit of more upside target here, and then move the stops as you see that these pivots are forming, right? 2 or 3 bars is for me a good sign of a pivot. 3, it's way better. We do have only 2 here, so 1 and 2, and 1 and 2. And 1. So really, this one is really a continuation of that move. It's not really that the market is coming back down. Okay. So that's the week out of the moving average. Now, why do I use more indicators? Just because it improves the probability of this setup to be successful. Okay, so if you do have a larger moving average above this, or a larger time frame where the moving averages are above this one, the probability of this entry is going to be reduced, and because it's going to find a larger time frame moving average above it, and it's going to be difficult for the price to go through. I hope that makes sense and it's clear. Okay. So now market has started to range. I'm gonna put another indicator here. Let me go and look for the indicators, and then I'm gonna go and look for the moving average. Where is it? Renko, open range, swing, SMA 50. Okay, I'm gonna put this one here, make it visible. Okay, so in the 50 SMA, this one is confirming the trend, right? So we have stacking, and that's why I call this, I put this stack Renko indicator up here. Okay, so in this case, the move is supported also by the 50. We have a 50 SMA, a 34, and an 18 SMA right there. Okay, so at all of this time, the market is giving us entries to the upside in the where the Renko chart is respected. Now, there is a trend reversal. So we do have continuation here, continuation there, and continuation here. Okay. Now, when we have this thing here, we are let's see. The question would be, okay, the question would be, with this trade here, do we take that trade? Okay, the week there's no setup here. Okay, so what so we need to be very, very, very conscious of what we're looking at. Is the price in this candle, is the price above the moving averages? The answer is no, it's not. So we do not have a trigger right here. Plus, I think that this one is the 30, opening range, the 30-minute opening range. But what? So if the price already passed through the moving averages, like what right here in this chart, in the entry chart, we do not have an entry chart or an entry trigger in here because we are not above the moving averages. We are passing through and crossing, but the trigger didn't happen above the moving averages. Okay, so it's very, very tempting, very, very tempting to go there and put an order here. And sometimes this one it's gonna work, but most of the time what happens is that it's going to be a short-lived right there. Let's talk a little bit about, and that's why I left this indicator down below here, which is the MACD or the MQ momentum is the one that I use. But you can simulate this one with the MACD. Okay, so the MACD is free. So you have here a high, you have here a lower high, but here you have a higher a higher high. So with these two, you can tell that there is already a divergence. Okay, then there's another one here. This one here is lower than that one, so you have another lower high, and here you have another higher high. More divergence. Hopefully this is clear. Okay, so hopefully that is clear. So another higher high and another lower high, which means that the market is going to go into consolidation. The probability is that the market is going to go into consolidation. And you have, 1, 2, and 3 already potential entries. So once these waves, 1, 2, 1, 2, and 3, then probably the move is already exhausted. Okay, so what you're looking for here is consolidation. Okay, if the move was important, then what may happen is that this one is going to start reversing. And another setup, if you look at the strategy videos, another setup is going to be a trend reversal breakout where you have a this wave. I'm gonna paint that wave there, that wave. Now you're making a similar low. This one is actually could be a higher low in here, but then this one is giving us a lower high right there, and then you would get a break out of that level there. Okay, so that is a potential entry, and obviously there is a resistance or a support at this point here. So you see that there's a wick right there, that or an up down move, trying to move up above this low here, which is acting as a resistance, and then comes back up. The market hesitates a little bit and then comes back down for another wave. And then in this case, you have one wave, two waves. No, I wouldn't say that one. I'm gonna take this one off, but this one is a pivot. Why did I didn't take this one? Because this one is continuation only. It's only 1 week or one bar moving in reversal, but then the continuation came. So it's only one. There's no pivot. While in here you have 3 in this side, and then obviously you have 3 in the other side. There's no significant space in between these two, or this one and this one. So 4 or 5 could have been a little bit better, but the good thing is that we are touching again the 34 EMA, or we are weakening out of the 18 EMA for a continuation there. Okay, so that's one. And so let's see what other so hopefully this one. Okay, so we have, according to what I said first, do we have an entry right here? There's a weak also bar. Do we have an entry here? No, we don't. We are above the moving averages. There's there is some resistance here in the opening range. What we could do is if we were triggering this one, and we had the stop loss right up there, it never triggered, came back up, and then moved here, moved there. We have now moving the stop loss up here, and then came back down, and then we need to decide when we are going to take the trade out. If you are doing a simulated account with or a test in your testing period with Apex, I would move the stop loss closer to this one. You don't want to wait until it goes all the way down and then all the way up to take it out, because this area here is going to be taken out of your daily threshold, and then you could fail because it moves in an intraday basis. Okay, so if you're which means that if you make money, let's say that you make $600, for giving just a number, and then you came back and have a stop loss, and you lost those $600. That $600 is going to move your intraday threshold for it. Okay, so hopefully that makes sense. I don't know if sometimes I explain the things correctly. Hopefully that one is okay. So now what happened here? So we don't have a week actually, we don't have a pivot, a real significant pivot, but we do have a continuation with a pause. So this is when I look at the other time charts and all of that and see if I have an entry. If I'm looking at the 2-minute chart, I'm gonna double check in here and see if we can make the entry, because sometimes this bar could mean that we have been in the day in the time chart, we could have been 10 minutes trying to decide what to do. So the more time we spend on that one is better for direction, because when it breaks, then it's going to break with more force. So we would have a period of consolidation within one of these bars. Okay, so that one is important. So we do have one. And then this one here, we never had a second entry. I would consider this one not an entry, just for the sake of not having a pivot. We do have a week, and you know what? It probably is an entry. I would need to see what the other charts are telling me. But you have 1 week here and 1 week right there, and this second week, and both of them are actually breaking or moving the price away from the moving average. Okay. So we do have one. We are in the middle of the opening range as well. So this market is horizontal, is moving bearish. So so we need to be careful in here. And then what we're looking for in these weeks, or in these entries, or either that one or this one, we're looking for 5 bars. Okay, that would be probably a potential target. We need, if we enter it here, then we're looking for 5 bars as a target. So in that way, you can either trigger it there, or you put the stop when it reaches the 5 bars. You can either go break even or move the stop within. It would be break even. So really you are losing the 5 ticks only. Okay. Okay, and I'm gonna check how much time I do have in this video. I don't want to make it that long, but I wanted to be also a little bit detailed on this one. I'm 42 minutes in this video. Okay, so let's continue here. So always look at what is happening to your left here. So always look at the price action there. We do have a significant pivot high right up here, and then we do have a significant pivot low right here. So anything in between these two things could be very choppy. And in fact, in this area here, we do have some choppy areas. So what happened is that the moving averages are crossing to each other too often. So I do have in this indicator here, I do have another parameter that I put here that alerts me when the crosses, right? So in this one is price which one? Color price back panel. Okay, that one there. Okay, so if I apply this one, you will see, and then I move this one a little bit to, let's say 40. I'm gonna do it this time. Okay, so in that way I can see it more clearly. You see that there is, this one is alerting me that the 34 is crossing above the 18, or the 18 is crossing below the 34. Okay, in here we do have a positive crossing. Okay, so in here we do have a congestion. Okay, crossing up, down, or down, up, and down. So, and then moving, finally move to the downside. Okay. Then it crosses above, crosses below, crosses above, crosses below, crosses above, etc., etc. Okay, so this is important. Why? Because when the moving average starts to crossing, let's take this example of this one here. So what we are seeing here is that the Renko indicator up here, right, is turning from red or gray into green. Okay, so what happened here is that we are going to look carefully what's going on with the moving averages. If the moving averages are tied together, they are in consolidation, but at some point it's going to break out of this area here. Let's draw it there. This one is a congestion area or compression area, and it's going to make an attempt to break. It's going to fail. Well, this one here, probably we have 1, 2, and 3. and moving a little bit to the upside. So I'm gonna leave it there. There's too much congestion here for me to take a trade. So I'm gonna leave it there, moving to the side, and then there's an upper level up here where the break could happen. Okay, again, always validate the higher time frames. Ikai, I think that is how you pronounce it. Sorry, sir. Okay, so then you move it. It's gonna break to the upside, and then the entry would be in that break. We do have here a target, and you have five breaks right from here to here that are probably a good first target there. Okay, so if it goes your direction, then as long as it stays above the 18 and the 34, then you should be okay. Okay, let's keep moving. So you do have here first wave, second. This one is not a wave. Remember, this one is only one bar, and it's we are extended in momentum, and then we have only 1 week. So this one is actually an extension of that move. It's a continuation pause. Okay. And then comes back here, and then you have a week out of the moving average. Now it already moved. It made one entry or 1 week or one pivot or one wave to here, and then second wave right there. You could take this one, but be cautious because in here you do have again a divergence. Higher highs in the price, lower highs in the indicator. Okay, 130, and look at this. Sometimes best entries or best trades are in between 930 or 945, not 930, 945 and 1030. So I'm gonna say here 1030. Okay, and in this case you would have a market that has been a little bit I would say sideways, and you go up and then comes back down, and then after this time it started to consolidate here. Always look at the time on your chart, right? If you have a 10:30 rule or even an 11 a.m. rule, just follow your rule. I mean, not that is not hard. If you only trade until 10:30. If the market moves in the afternoon, that's so be it. I mean, that's what it is, right? Sometimes there are some really nice move lately that has happened at lunch. But during that hour, if you're having lunch, then you're having lunch. That's what can you do? Okay. All right. The other thing is that if the market already made a move in the overnight or because of news, then probably going higher is going to be difficult, right? So like in this case here, you do have 6 p.m. the day or not 6 p.m., 5 p.m. the day before 6 p.m. opened, right? And look at this move right here in the not the overnight, was all the way here, was already moved. So a move. So a continuation could happen right out of the gate, like in this case. But then if you're trying to get something here, it's probably already the move already passed, and for that you have to look at the 4-hour chart. Guys, if you like this video, please hit the like button. I would appreciate it so I can have more traffic. Okay. Let's see what other indicator. So these are mainly the other one that I really like is the 50 of 50, the smooth 50. So let me look where is it? This one here. I'm gonna activate this one, and I should probably take and isolate this. I'm gonna leave it there. No. You know what? I'm gonna take the cross builder off, and then I'm gonna take the other SMA 50 off, and I'm gonna talk just about the smooth 50. Okay, smooth 50. It's another strategy. So it's also a week out of the moving average that we are looking for here. But basically, what we want to see is that the triggers happens above this. This one, it's going to be visited less time during the day, right? So, for example, here where we do have a trend reversal breakout here, right? It happened crossing the smooth 50 as well. Look at that. Okay. So remember we talked about this one, higher highs, higher lows off of these moving averages right here that we just saw, and then came back, made a lower high, and then when it broke to the downside, it was crossing the smooth 50 as well. Okay, this one is a harder, a tougher moving average to break. But in this case, it broke here, continuation, moved up to that point where it found the smooth 50. Again, 50 moving average of 50 moving average, a nice short-term move right there. And then it started to consolidate at 1030. Okay. Then moved above the smooth 50, made a week out of the smooth 50, third week out of the smooth 50, and finally moved up. And then moved up. Went a little bit away from the smooth 50, came back down, and then this one here opens below the smooth 50. Look at this. What happens here? The bar crossed the smooth 50 and then closed above the smooth 50. So in this one, you have to be very, very careful because this one here is actually this one here is actually a resistance. It's a trade into resistance, but it's a little bit above. You have a week out of nothing. Our strategy indicates that you have a week out of the moving average. So if you have moving averages below this here, it's going to be resisted by the smooth 50. Okay, so you have to be careful on that one. And you see that there's a lower high right there. From this point to this point, there's a lower high, which means that we are in compression. And then you have here another week, but the week out of the 30 range, and then moved up and crossed the smooth 50. But we are still in compression. Okay, we could argue that we do have lower highs, lower low here, and then comes back up and then make a higher low, and then you do have a trend reversal breakout right there, right? But there's no space up here for these candles to move for a larger target. So if we count here, we have 1, 2, 3, 4, 5, 6. We're kind of right in there to get our first target out. Okay, so that's a very, very risky trade. It worked in this case, but you have to be careful. The other one is this one, right? If hopefully you see this. This is another setup that I look very often. So you see that there. Okay, and this one here. Okay, that's a triangle formation. Okay, high or higher highs, high, lower high, or low, lower high, higher low, and then a break out of there. This is in this one here. You can take a riskier trade because you have some resistance up here. But when it breaks not in a large target. But in this case, you're getting 2 points more that would allow you to have more distance to the top of this area here. So, but again, it's a short-lived trade. Hopefully that is clear. Okay. And this one happens in the afternoon. So, so that's that. Okay, let's go back to the indicators again. And I'm going to look for the Ichimoku cloud now. This one here, Ichimoku cloud. And there's another strategy or another setup. I'm going to take this Ninja, where is it? Out. I'm isolating indicators here. I'm isolating indicators. And really this one here, the open range, I'm going to take it out as well. Not doing that much here. Okay, so now we are looking at the Ichimoku cloud. In the Ichimoku cloud, we are taking trades only in the favor of the Ichimoku cloud. Okay, so let's look at this chart again. 9:30. Okay, we do have our 15 minutes opening range right there. Price is above. It doesn't matter really the color. I don't pay attention to the color. I know that question is going to probably come back later. But then you do have a green, or you do have the Ichimoku cloud below the price. So we're looking at wicks out of the Ichimoku cloud. Those are more randomly happen. So, but we have to look at let's look at those, and then we again this one is probably not ideal because we already have some big move and large move here, and we are trying to go above the resistance, the mid resistance level here. So after the market moved pretty significantly over there, we do have an Ichimoku wick out of the Ichimoku cloud right there. Let me put it larger. Let me check the time. We are an hour. Okay, so the video is a little bit long, and I don't want to have long videos in YouTube. But what I'm gonna do is to talk about the Ichimoku. I'm gonna cut the video and I'm gonna start all over again for another video. Okay. So what time is they changed the time today? So it's 11:16 a.m. Eastern. Okay, so here we do have Ichimoku wick out of the cloud. Oh, I'm sorry. I'm sorry. A wick out of the Ichimoku cloud. Let's call it. Let's call it wick out of the cloud. So we do have one here. That one is a valid entry. The problem though is that we do have, if you look at here, we do have, that one is not, we do have negative momentum right there. Okay, so momentum is negative, and we're triggering a wick out of the cloud right there. So it's not supported by momentum. Again, right there, we do have a trend to go, excuse me. We do have a wick out of the cloud that is not supported by momentum in this case. Okay, so high possibility is that it's going to fail. Now we do have another wick out of the cloud right here, although this one is a wick, but it's a up down out momentum, so it's, or a up down move, so it's not really a pivot, but we do have a wick, and then it is supported by momentum in this case. Okay, so we could argue that we could take this one here. There's a wick out of the cloud there because they started off of the in the cloud and then broke up outside of the cloud, right? It's closing outside of the cloud, so we could tell what thanks for doing this, sir. Okay, yeah, you're very welcome. Now I'm not going to talk, probably in another video I'm going to talk about the setup for the MACD, but I do have a video in the strategy playlist where I explain all the indicators one by one, and if you look at it starts with HD, so for high definition, because I discovered how to make videos with high resolution there, so I titled that one HD dash setups or something like that. So look for that video, and in that one I explain what is the setup for the MACD to simulate this this one here. Okay, so let's continue. So 2 double wicks. This one is a strong signal plus reset of momentum right there. We can argue that this one would be a valid entry. Let's look for another one. Up down. This one is also I like this. This is a consolidation. Now the problem in this one is that I am outside of my trading area, right? If you look at the time, it's way beyond 10:58, and that is not when I trade. So but then at 11:30, we do have a wick out of the cloud right there. We do have a wick out of the cloud right there, but we are in an area of consolidation or compression right there, formed basically by this 1 and 2 values, right? So the first one touches, I'm not going to consider this one as second because or two second attempt on this one, because, and the reason is that they are too close. Okay, so when they are too close right here, I just take consider it as one, right? Even though there's two even though there are two handles or two bricks before and after, but they are too close, so I just consider one touch. So this one is one touch, that one is a second touch. The third touch most of the time goes out. and if it triggers, remember to take a stop around this area here, or even closer. I would say below that this breaking there, that part that is breaking above, then the stop loss goes there, and your target is going to be a larger one right there. Really nice move. Actually, momentum really went up there. Week out of the cloud. That's the call of this one. Now you do have another week out of the cloud right there that failed. Momentum again is below the zero line, so riskier to take. And again, divergence. And now in the afternoon, sometimes you have big, large moves in the afternoon. But you know, if you're a full day trader, or a trader that trades the whole day, then that's you could take advantage of those things from time to time. Okay, so let me see. Okay, I'm gonna end the stream, but I'm gonna come back. So I'm gonna get some water, and then at 11:30 I'm gonna go back and talk about other things. All right. Thank you so much for watching, and see you in about 10 to 15 minutes.